Welcome to this next session, which is on housing. I'm Rob Joyce, and I'm a Deputy Director at the IFS. And once again, we have a fantastic panel to help with this discussion. The order we're going to go in is my colleague at IFS, Boileau, will start by talking about some recent work that we published, or that B and colleague and David published on home ownership and what's happening there and why. And then my other colleague, Peter Levell, also at IFS, will talk about some ongoing work looking at housing supply, essentially, and how that differs across the country. And then we have three fantastic discussants who will give slightly shorter comments of their own. Anthony Breach of the Centre for Cities, who's their lead on housing and planning. Ian Mulheirn, who's at the Resolution Foundation, formerly various roles at the Tony Blair Institute, and directing the Social Market Foundation, for example, and he's going to be drawing on some of the work that he's done in recent years, of which there is quite a lot on housing. And Tom Clark, contributing editor at Prospect, who is going to, I think, wrap things up, and then we'll move into some discussion and Q&A. I hope that sounds good. And earring. There was an earring that was found. Actually, not exactly sure where it was found, and I don't have a detailed description. But if there was one of them. So if you're feeling a bit lopsided or something, it's at reception. So do check whether you're missing one. That I think is a wrap on that. So let's get cracking. B, if you'd like to kick us off.
Okay. Thanks very much, Rob. So I'll be talking about some work that David, Starrick, and I have been doing, looking into the kind of role that's being played by gifts and loans in home ownership rates among first-time buyers. A large part of what's motivating this project, this kind of strand of work, is the way in which home ownership rates have fallen among younger cohorts in recent years. And we know that not only have home ownership rates overall declined, but they've declined more dramatically for those whose parents don't own their own home. So on the slide here, I'm showing you the home ownership rate among those aged 25 to 39, among those whose parents own their own home. And you can see that among this group, home ownership rates have fallen from around 60% in 2009 to close to 50% in 2019. And so they've fallen by about a sixth. When we look at the home ownership rate among those whose parents rented their own home, though, you can see that not only did this rate start at a much lower level, at around 40%, but it's fallen much more dramatically, almost halving to around 22%. And there are many things that could be driving this kind of large and increasing gap. So lots of this harks back to David's discussion this morning. We know that wealthier parents are likely to have children who have higher levels of education and higher earnings themselves. And these factors might make them more able to meet the kind of increased financial demands of getting on the housing ladder in a period where house prices are high. We also know that the children of wealthier parents are likely to save more and potentially in higher return assets. But another important thing that we think is likely to be driving this growing gap is the role of direct financial assistance from wealthier parents to their children directly. And beyond kind of anecdotes about the bank of mum and dad, there's strong reasons from other data sources and previous research to think that this kind of help might be playing a growing role in driving these kinds of differences in home ownership rates. We know, for example, that an increasing share of first-time buyers say that family members help them to afford to put down their deposit. This has risen from around 22% overall in the mid-90s to around 29% in the middle of the last decade. We also know from previous research at the IFS that more than half of the value of gifts and loans overall that are transferred between generations are reported to be used for property purchase or improvement. And finally, we know that people who have home-owning parents are more likely to receive money at any given time and more likely to receive higher amounts. So in this project, what we've chosen to focus on is kind of two key questions surrounding the role of these gifts and loans. We first ask how important they are in driving the increasing inequalities in home ownership rates that we see between different groups. And then we ask what role these gifts and loans given around the time of home purchase might play in broader patterns of wealth accumulation. And throughout, we used the Wealth and Asset Survey to investigate these sorts of questions. I won't talk in too much detail about the exact nature of the data, but it's a particularly good data set for these kinds of questions because it's got detailed information about the gifts and loans people receive, as well as about details of their home purchase decisions. So to start off with, we know that this kind of help, so the proportion of people who receive gifts or loans in the time surrounding home purchase, is relatively common. we find that around 4 in 10 first-time buyers receive at least one gift or loan in the 4 years surrounding home purchase. And on average, among those who receive it, the sort of help averages around £25,000, so it's fairly substantial. As you might expect, this isn't evenly spread across all first-time buyers. So more of those in their 20s report receiving this kind of help, more of those whose parents are better off, perhaps unsurprisingly, and more of those who are buying in the southeast and in London compared to other areas of the country, so the Midlands and North. And one way of getting at the kind of size of these transfers and their kind of importance in home purchase is by looking at the proportion of people's deposit that they represent. And we do this both overall, and here I'll show you the proportion broken down by different parental statuses. This is using a similar split to one that David described earlier. We break people down by whether their parents rented their home, those whose parents are homeowners who didn't attend university, and those whose parents are homeowners, but among whom at least one parent went to university. And you can see that there are inequalities in the average transfers received. Note that this is among everyone, so we'll be including some zeros from those who don't receive any money at all at the time when they're buying a house. And you can see that although those whose parents are better off are putting down slightly larger deposits, that difference isn't large enough to outweigh the differences that we see in the size of transfers that are received. And these yellow triangles represent the proportion of the deposit that transfers among all first-time buyers represent. You can see that this is around 5 to 10% of the average deposit put down among those whose parents are renters or who are low-educated homeowners, but rises to about a third of the deposit for those whose parents are the best off. And so we know that this kind of help is really important. And we can look at all renters and we find that those who received a gift or loan over the last 4 years are 8 percentage points more likely than similar renters who didn't receive one of these transfers to buy a house in the same period. But the effect of this kind of help is bigger than might be immediately apparent for many first-time buyers. And to explain this kind of different outsized effect, we can think about 2 constraints that people have when they buy a house. So we can think about a savings constraint. We'll assume here that people are required to put down a 10% deposit as a proportion of their house price. And there's an income constraint, so we assume that people can only borrow up to 4.5 times their earnings. And it turns out that transfers have a different effect depending on how high people's savings are in relation to their incomes, so which one of these kinds of constraints is binding. Thinking first about those whose incomes are quite high but who have relatively low savings, we assume that these people are putting down the minimum possible deposit and aren't borrowing as much as 4.5 times their earnings when we think about the biggest house they can afford. And for these people, receiving additional money not only adds to the deposit that they can potentially put down, but means that they're able to borrow more alongside that, meaning that each £1,000 of transfers they receive can have a £10,000 effect on the biggest house that's affordable. For those whose savings are relatively high in comparison, so who are borrowing kind of the maximum amount that they can afford, but whose savings are kind of higher than 10% of this house, additional money that they receive is just going to add to their deposit rather than allowing them to borrow more. So transfers have more of a one-to-one impact. And it turns out that those whose savings are relatively high in comparison to their income, so those for whom transfers just have this one-to-one impact, are exactly those groups who tend to be more likely to receive money and to receive more, forming a kind of caveat to what we've presented so far. So we can show this, breaking down people by a similar split to what I just shown. And you can see here the average transfer received by people whose parents are different statuses, and then, again, overall. But we can then present the difference between the average house, or the biggest house on average that they can afford, not taking into consideration the gifts and loans that they've received, and the biggest house that they can afford, taking into consideration those transfers. And this is presented here. You can see that for all the groups we consider, as well as overall, there's this outsized effect of transfers on average, with transfers increasing the biggest house you can afford by more than just their kind of absolute value. But you can see, too, that this kind of outsized effect is lowest for those whose parents are the best off, although the biggest house they can afford is increasing by the most. And the yellow triangles here represent the kind of multiplicative effect of transfers. You can see that for those whose parents are renters, each £1,000 of transfers is, on average, increasing the size of the biggest house they can afford by more than £4,000. Compare this to those whose parents are high-educated homeowners. Because their savings tend to be relatively high in comparison to their incomes, each £1,000 of transfers is increasing the value of the biggest house they can afford by more like £2,700. So far, we've been thinking about these gifts and loans as kind of meaning that people can buy a house sooner rather than later. They might mean a 10% deposit is attainable, or mean that people can now cover the whole house price, taking out a mortgage of 4.5 times their income. But of course, these transfers can act through other ways as well. So receiving a gift or loan might let you put down a bigger deposit on a house that you're already going to be able to buy, meaning that you can make lower repayments for your mortgage. It might also allow you to buy a higher value house, the one that you would already be able to afford. And finally, it might let you have higher spending or save more before you buy a house compared to those who don't receive this money. And there's reason to think that these other sorts of channels beyond just the first channel are important here when we're thinking about these gifts and loans and home ownership more generally. And one reason to think this is that we find that a minority, but a substantial minority of people who receive these gifts and loans are receiving while they could already afford to buy the house that we then see them buy, in that they have a deposit saved of 10% of the purchase price, and that taking out a mortgage of 4.5 times their income plus their non-transfer savings would cover the purchase price. And you can see this here. So here I'm showing you the proportion of first-time buyers who received a transfer and splitting it by whether they could or couldn't previously afford the house we see them buy. And it's worth noting that in WOS, we're seeing people between 0 and 2 years before they buy this house. So this could be a sort of lower bound on the proportion of people who could already afford. And there are also some strong regional differences I'd like to bring out here. So we see that in particular in London, around half the first-time buyers who receive a gift or loan around the time of home purchase could already afford the house that we see them buy. And this implies that for this group of people, transfers are potentially acting through these other channels that we think about beyond just allowing them to afford their house. And so here, to get at which ones of these additional channels might potentially be more important, we look among all first-time buyers who receive something, and we ask what's the association between receiving additional money and where the money goes. So we look at the effect of an additional £1 on both the house price and the deposit that they put down. And there's some sign that potentially receiving more in transfers is associated with buying a more valuable house, but this is insignificant and relatively small in magnitude. Instead, it seems to be the case that those who are receiving more are using that additional money to put it directly into their deposit, implying that receiving more is associated with putting down a higher deposit as a fraction of the house price. And it turns out that using money to increase the size of the deposit you put down can have really high financial returns, and so has really important implications, potentially, for wealth accumulation patterns. So to illustrate this, I'll talk finally about the kind of return to alternative uses of transfers. Increasing the deposit that you put down from 10% to 25% of the home value has kind of two effects, lowering the interest payments that you're making on your mortgage. There's first this kind of mechanical effect, you're borrowing less money, so there's a smaller principal in which you're making interest payments. But there's also this additional interest reduction effect. If you take out a mortgage with a lower loan-to-value ratio, you're able to access lower interest rates, meaning that you're paying less in interest overall. And so overall, these two effects added up are the total return in the first year of increasing your deposit by this much. We can compare this to other ways in which you could potentially use this sum of money. When we illustrate the returns to putting that amount of money in a cash ISA, you can see that consistently through the periods considered here, the return to putting that money in a cash ISA has been considerably lower than the total return to increasing your deposit. That's even the case when we compare increasing your deposit to investing in equities. You can see that this return has been volatile through the periods we consider, and there are some years in which the return from investing in equities has been higher. But in general, the return to increasing your deposit from 10% to 25% has had a much higher return than investing in equities, and is also much less volatile. And so we've seen that home ownership rates have fallen steeply, and that in particular that's taken place for those whose parents don't own their own home. The children of homeowners are now more than twice as likely to be homeowners themselves than the children of renters. And it seems that parental transfers are playing a role in driving these kinds of home ownership inequalities. And these transfers are particularly large for those whose parents are themselves better off and those who are buying in London and the wider southeast. It does seem to be the case that because of savings to income ratios, these transfers have less of a transformative effect on home buying power for these groups. And they're also more likely to already be able to afford the house we then see them buy. Finally, those who receive more in transfers seem to be using it to put down bigger deposits. And as we've just seen, that tends to have very high financial returns, meaning that this is likely to drive differences that we see, not only in home ownership rates, but in wealth accumulation between different groups. Thank you.
Okay, we're going to be suspended in midair for a second while I transfer from PowerPoint to PDF. Don't hold your breath. View. Okay, great. Yeah, so this is a bit of a bait and switch. We sort of lured you here to talk about social mobility and wealth, and I'm going to talk about housing supply. Sorry about that, but they are related, and maybe we can sort of bring that out in discussion. I'll say a little bit about that. Yeah, so this is some work we've been doing at IFS. This is joint work with Elaine and David, who are both here, on the microgeography of housing supply in England. And the motivation we had, at least for starting this, is that we thought the UK policy debate was really dominated by three big questions. One is really weak productivity growth since the great financial crisis, both relative to trend, relative to other countries. Two is there's these large spatial inequalities in opportunities and living standards that sort of the leveling up agenda is aiming to address. And three, there's these ongoing complaints about high housing costs and poor quality housing. I could also have added here sort of unequal access to home ownership and the kind of issues that B was discussing. We thought, maybe some of these things are related. And one of the things that might be a factor, significant for all of those three questions is local housing supply. So the question we're thinking about is what extent low housing supply in high productivity areas, for example, reduces national productivity growth, and do the differences in where we build houses affect who lives where? But then we thought that, okay, there seems to be, we thought there was a bit of a gap in the evidence on this, little evidence on how local supply in the UK responds to local demand changes, and that's what we're trying to measure in this project. So the way we're going to measure this is we're going to measure which are called local supply elasticities. This is a key measure of just how the local housing stock responds to increasing demand in an area. So you can think of this conceptually. Do areas with greater growth in housing demand for housing also see greater increases in housing supply? The elasticity measures what the percent increase in supply is for each percent increase in price. So I'll talk about these later, but if I talk about an elasticity of 0.1, it means house prices double in an area. This is all going to be relative to other areas. So relative to the average, then local supply will increase by just 10% more than the average. So elasticity will be low and the supply response will be weak. Of course, there's different ways you can measure these things. You could think about how you're going to measure the supply of housing. Is it the number of housing units, the number of bedrooms, which we also use, the size of the houses, which we don't have as great data on. And then over what time period you're measuring these things, 25 years. We're going to be thinking about a time span of 10 years. You've got 10 years to build a house's response to a price increase. What we do in particular, so we've assembled this data set of house prices, quantities, the housing mix, and physical and regulatory constraints at really low levels of geography. So this is for every MSOA, if you're familiar with this terminology, or local authority in England. It's about 7,000 MSOAs in England, so this is a really small area of geography. We're going to measure how local supply responds to local price changes across these different geographies, and we're going to measure the importance of the different constraints for determining these local supply elasticities, and there's like geography and regulatory constraints. And then we're also going to look at how these constraints affect the supply of different housing types, so larger versus smaller units. The sort of next stage of this project is to understand how these constraints affect the growth of the local workforce in response to local labor demand shocks. If the town becomes more productive, can more people move there because we build more houses, or does the house prices just go up and there's no increase in the local workforce? So in all of this, we're bearing in mind a particular issue, that if there was an increase in local supply in some area, maybe there's relaxation of rules, or they just decide to build a lot of housing to development, that would boost the quantity and also lower the price. But that's not what we're trying to measure. We're trying to measure the impact of an increase in demand on local housing supply elasticities. So to deal with that, what we do in the project is we use price growth that's driven by local job opportunities. So, if there's an increase in local employment growth or access to jobs, that pushes up prices, and then the question is how much does that lead to additional supply? So we've take our data from the valuation office. This isn't a particularly interesting slide. House prices from the UK Land Registry. There are the constraints, satellites and all kinds of wizardry. We're considering two periods of house price growth So as I said, we're looking over these 10-year periods. So the first one is this boom period from 1996 to 2006. So their real house prices doubled. So there's a really big increase in house prices. And the second period we're looking at is from this sort of trough in 2011 up 10 years later up until 2021. So this chart has been known to kind of create feelings of surprise and fear and anger. So if you're feeling any of those things, it's perfectly normal. But the sort of interesting thing here, I think that, and Ian Mulheirn's done a great job of pointing this out, is that over the last 10 years or so, real house price growth hasn't been actually that high. But there is some, and we're using that. So this kind of, these national trends, these disguises these big differences across areas. So here we've got the percent changes in prices in MSOAs. So the deep purple ones are the places that really saw big increases in prices, and you can see London there, and Southeast is a bit less, and then there's sort of less price growth in the north, and even real house price falls no, actually they're not price falls, just very small increases in some parts. So there's a lot of variation in price. This is a not particularly helpful graph of changes in quantity with a not particularly useful axis. Sorry about that. But I mean, the key point here is that it's not really tracking the areas of the price growth. There's a sea of green with specks of purple. Just an idea of some of the constraints we're looking at. So this is one of the constraints we're using. So the share of land available for development. So you can't build in places where there's already building or there's greenbelt national parks. So you can see that those white areas are places where there isn't as much land to build on. This is going to be one of the key constraints. So I haven't sort of included the pictures for the others. So just the highlights of our findings. So we find, surprise, weak response of local supply to local price changes. So if you take an area with average characteristics, supply elasticity is between about 0 and 0.15 for both periods of house price growth. So the key point here is that supply growth doesn't track local demand for housing. And if you take a study that used a very similar method for the United States, they got an elasticity that's twice as big, so 0.3. So the supply is much less responsive than it is in the US. When you look across the constraints and which ones matter, so there's weaker supply responses in areas which are more uneven topography, it's harder to build on, where there's less land available for development, and when there's high historical housing density, so that it's just places where it's just harder to build. And then we also, when we look at these different housing types, we see that these land constraints, so housing density, the amount of land available for development, does much more constrain sort of big properties than small properties. So you end up getting relatively more flats and relatively few 3-4 bedroom properties. Here's the map of the elasticities. So the kind of elastic places, the places where it's relatively easy to build in response to demand change, that's over in the east of England, so they tend to be more responsive. And then the urban centers, they tend to be less responsive to demand. This is for the first period. For the second period, actually the average elasticity is roughly the same, but there's a bit more dispersion. That's because we find that the share of land available for development is more important in determining variation in the second period. So these are low numbers everywhere, but they're lower in some areas, and particularly, sometimes. So if you laid on a map of kind of average wage growth in places, you see some of these high wage growth areas also happen to be areas with low elasticities. We've broken down the variance into the contributions of these different elements, and you can see that what really matters for driving the differences in responses is the housing density, existing housing density, and the share of land that you can build on. I'm trying to wrap up quickly so we can get to discussion. So the implications of all this and for next steps. So if an area improves in productivity and more people want to move there, supply may not keep up. So how is that going to affect national productivity? So that would depend on workers' ability to access those high productivity jobs. That doesn't mean you have to live in the place where the productivity is increased. Maybe you could commute there. So the willingness to commute to those locations is a sort of key determinant of how much of a brake this would put on national productivity growth. And also, we've been talking about, so the access to these high productive areas, these high wage jobs, high wage areas is going to depend on if the supply response is weak, it's going to depend on your ability to access capital, and that might depend on your parents' resources, and that might have implications for social mobility. And so, the next step we want to get on to is to measure the impact of these elasticities in the different areas on local workforce growth. That's something we're still working on. And I'm done. Thank you.
Fantastic. So we will move on to the three discussants, I guess, for want of a better word. Can we start with you, Anthony?
Yeah, sure thing. Thanks, Robert. Thanks, Bea and Peter, for a great presentation. So, geography matters to the national economy. I was really pleased to see both read the paper, get a preview of it, and also kind of hear Peter's presentation there. Both because they're great pieces of work, but also because there's such a strong focus on geography and how that interaction between local labour markets matters so much for individual outcomes and also kind of national economic performance. So I was particularly interested, I think, in Bea's paper, where there's this kind of logical but quite counterintuitive results from wealth transfers and access to home ownership, in that you have this greater magnitude of transfers in the south of England, but this counterintuitively, kind of the importance of the transfers and accessing home ownership seems to be more important outside of the south and in the north and in the Midlands. And to me, what that really says is that, while people often talk about, regional inequality and spatial inequality, the whole levelling up agenda, and people also talk about generational inequality, especially when it comes to housing, there's actually a combination here in which there's an intergenerational spatial inequality being produced by this interaction between wealth transfers and access to home ownership. So on the one hand, it's easier to access home ownership in the north of England and in places with less successful local labour markets. But on the other hand, home ownership gives you greater benefits in the southeast of England around London. That's why it's more expensive, and that's why kind of housing equity is also greater. So we had a paper, maybe it was great, back in 2019, looking at what's the geography of housing equity and how that changed from 2013 to 2018 across England and Wales. And to kind of illustrate this point, you can imagine almost two home-owning twins, one who lives in Sunderland and one who lives in Brighton. And the twin in Sunderland would have seen their housing equity go from about £90,000 to about £93,000 from 2013 to 2018, whereas the twin in Brighton would see their housing equity go from £217,000 up by another £85,000 to £300,000. So not only is there a much greater absolute growth change, there's actually faster growth in the places with the highest local wages and highest local labour markets. So we see that, that doesn't just mean that, Brighton is less affordable for people who live in Brighton, but also we see that it's harder for your wealth transfers, if you live in Sunderland, to go far enough to allow your children to access the most prosperous and most successful labour markets in the country, either temporarily, whether it's for renting, in terms of deposits, I think also more importantly in terms of home ownership as well. So there's this kind of combination of effects where, because local, if housing is our main asset, which it is for a lot of households in the UK, and we know that local labour market outcomes are really important for your individual household outcomes, the fact that house prices are so closely correlated with local labour market outcomes means our model is really struggling to share risk between different households across the national economy. So why do we have this? Why do we have this kind of such a perverse model? I think, as Peter was showing, a lot of it is to do with supply and demand and the restrictions we put on building housing, especially in the most expensive parts of the country, especially in and near growing urban areas, particularly London. I mean, that kind of white silhouette I was seeing on the map, that is just the green belt, right, around London and around the big urban areas in England. So, this supply and demand effect, takes place at both a national level. We've done some work showing that since 1955, and the planning system was introduced in 1947, we're missing about 4.3 million homes, so about 15% of our stock, relative to a bunch of peer Western European countries. But there's also, as Peter was saying, there's these local mismatches in supply and demand. And we did another paper back in 2020 that was published a week before lockdown, so we didn't get much coverage for it. They're basically showing that actually that this kind of, at the local level within urban areas, you get this kind of effect where you see pockets of very intensive supply. So about 4% of all of the LSOAs, so kind of a slightly smaller geography than what Peter was showing, provided 45% of all new houses in urban areas from 2011 through to 2019, whereas half of all neighborhoods in our urban areas were building one house a year or less. So there's kind of this concentrated pocket effect, which is driven by the restrictions that the planning system places on both development within urban areas, but also on urban containment as well. So in terms of, I think there's, there's stuff we can do, I think, in terms of, how we tax wealth and how we tax transfers, and, that can plausibly make things more equitable. But I think the key thing is that, we really need to be having a discussion about how we improve that kind of supply and demand connection and improve elasticity, which means going back to the fundamentals of our planning system and moving from our internationally quite exceptional discretionary case-by-case planning system, where even if you follow the rules, you don't always get a planning permission, towards one that's much more normal for European countries, like a much more zoning system, where you're planning for transport and you're planning for housing at the same time, and where if you follow the rules that are set out in the local plan, then you're guaranteed a planning permission. Now, I think over the past kind of 24 months, we've seen increasing discussions about planning reform. It's risen up the agenda. But I'm pretty hopeful that we will be able to move in that direction. And obviously, what that means is we don't just need more houses nationally. We need to fill that 4.3 million we're missing, but in particular, we need to build more in those most expensive places to really improve national productivity performance and also to reduce inequality across the country, because geography matters to the national economy. Thank you very much.
Really interesting, thank you. And can we move to Ian?
Come and stand up here so you can see me. Thanks, Rob. And thanks to Bea and Peter for those fantastic presentations. There's so many, I know it's a bit of a bait and switch, as you say, but everybody loves a good housing debate. And in any case, I think housing touches on so many aspects of social mobility that there's lots of different ways you could take this discussion, but your two sort of excellent papers give us something to sort of focus minds on. So I'll say a few words about Bea's report, which I really enjoyed reading earlier this week, and then a bit about Peter's analysis, which I think presumably is forthcoming, but looks very exciting too. And I guess on some of the things that Bea was looking at, I think what's quite useful is to put that in some historical perspective of what's been driving home ownership in the UK over the past 40 years or so. And I'll be drawing here mainly not on Resolution Foundation work, but on work from the Tony Blair Institute that I did with colleagues there last year. And I think what you see, what we see in the pattern of home ownership is that it really surged in the later post-war period and through the 80s particularly. In the mid-80s, it was in its low 60s%, and it peaked in the early 2000s at about 71%. And then after the financial crisis, it started to fall, and then after the financial crisis, it really collapsed back down to about 63% back in 2016. So we sort of went up the hill, went down the hill, and it's since started to recover, but it's sort of around 65% now. And I think what we sort of found from looking at the history of it really is that there are really three main drivers that you can think of as being key to determining home ownership. One is credit availability. The other is the price to earnings ratio for houses, and the third is what the sort of subsidy environment is. And on each of those things, you can sort of see what drove home ownership up in those to that peak in the early 2000s, then what made it crash. So through the 80s and 90s, we had massive banking deregulation, the mortgage market got deregulated. Loan-to-values numbers for first-time buyers were eye-wateringly high, huge availability of credit, and that caused home ownership to surge. We had relatively low price-to-earnings ratios, despite some booms and busts through that period. And we also had things like MIRAS and other subsidies, notably the right to buy, which also had a huge impact driving up home ownership through the 80s and 90s. And then all three of those forces then went into reverse. So in the 90s, we started to see right to buy trickle out. MIRAS largely came to a halt. And then in the 2000s, we saw prices jump, as we've just seen from Peter's slide. The price-to-earnings ratio went through the roof, making housing unaffordable for many people and tightening that deposit constraint. And then we also saw, after the financial crisis, a massive sudden stop in credit to lower wealth first-time buyers, and then increased regulation on that lending for reasons of financial stability. And those three things together progressively put a massive downward pressure on home ownership. So the question about what's going to happen next with home ownership really depends on what the outlook for those three forces are. And I would just say, in terms of subsidies, it doesn't look like that's coming back in a big way, nor probably should it, really. In terms of credit availability, in terms of house price to earnings ratios, I think the rise in interest rates, if it's sustained, is likely to mean that price to earnings ratios drift down over time, even if they don't fall rapidly. And with colleagues at the Resolution Foundation, we did some work on that last summer, which suggests that if interest rates stay where they are, you could be looking at significant improvement in affordability eventually. And then on credit availability, that's probably the only real policy lever that would make a massive difference, or make a significant difference, rather, to home ownership. And I think in the report, B and colleagues touch on some of the possible things you could do around credit, mortgage interest guarantees and long-term fixed-rate mortgages to tackle both of those constraints, the deposit constraint that people face, but that's not the only thing. You also need to tackle the affordability constraint that some households face, and that 4.5 times income sort of bar that they need to clear, which if you could ensure the risks that banks and lenders face when lending to first-time buyers, then some of that would ease. Now, that wouldn't revolutionise home ownership, but it probably would push it back towards that sort of 70% mark we had in the early 2000s. So that's what. So that's on that. Briefly on Peter's analysis, I think. A couple of points I'd make about that. One of the things that's really striking is obviously how density and built-up areas we struggle to build in. And I think one thing that everybody in the housing debate would agree on is that for reasons of productivity and economic growth, and the Resolution Foundation's recent Ending Stagnation report said a lot about this, increasing the density of some of our cities is really key to that. So building in already built-up areas is something that we are not very good at and we need to get better at. And I think that is a definite thing that comes out from looking at those really striking maps. But I wanted to comment on a couple of the sort of more technical aspects of the analysis, just to give some food for thought. And these are things that I've sort of only sort of half-baked thoughts, so we'll see what you make of them. But Peter, in your slides, you say the kind of you're looking at how jobs drive prices and then prices drive supply. And I think I have some questions about both of those links, which might be helpful to unpack. One is that there are really two prices in housing. There's only one form of supply, but there are two prices. There's the price of housing services, which is proxied by rents, and there's the price of housing assets, which is the house price. And they don't move together. They're driven by different things. And this century, we've seen that prices have grown much more than rents. That huge jump in prices before the financial crisis was in the face of relatively benign rent levels. In other words, housing yields fell very rapidly, and they've remained low with some bouncing around since. But what we've also seen is a divergence of yields in different parts of the country. So at least until the pandemic, we'd seen yields in London falling a very long way, i.e. prices rose much further than rents in London. And in other areas, that divergence was, that fall was less steep. So there was a big divergence. And the IMF has highlighted how global cities have tended to see as being a common trend across quite a lot of globally integrated cities, that we've seen prices accelerating away from rents, which sheds some doubt on what is it that's driving these prices. It's clearly not just employment and demand for housing services, which is somewhat more benign. Well, you might say, well, it doesn't really matter. If prices are going up, there should be there's increased demand for housing, even if it's just as an asset, and supply should therefore respond. And I kind of struggle with that a bit because I'm not sure whether this is the right way to think about housing. Now, in a competitive market for goods, this is obviously the correct way to think about things. You know, if you have a demand shock, the price of the good will rise, people will see an opportunity to make more profit, supply will respond, and more production will act to reduce the market clearing price back to the equilibrium. But housing and land are primarily assets, they're not goods. And what that means is that the owner of an asset has really a one-shot decision. If they sell, and they're out. And they can cash in and liquidate their assets at any given time. And really, developers or any homeowners are effectively investors in that regard. They only have that one opportunity. So the question really for them is not what happened to prices yesterday, not what matters for their decision about whether to sell, is not what happened to prices yesterday, but what's likely to happen to prices tomorrow. If prices doubled yesterday, but I own a big patch of land, and I think they're going to double again tomorrow, then I'm not going to sell. So with any asset, in any asset market, it is that determines when people supply land to build or to, their timing of their sale. And I think that means that I'm not quite sure what a supply elasticity means in this situation. So I think the approach, so in a sense the analogy isn't if the price of bread rises, then bakeries will want to produce more bread. That's not the situation with housing. What the situation is with housing is more like if the value of the baking company goes up in the stock market, do the owners choose to sell? No, they don't. It's their decisions on holding or selling are sort of irrespective of past changes in price. So I don't quite know how to sort of reconcile that with the idea of price elasticity. I hope in our discussion we'll be able to get into that a bit more. Thanks.
Thanks, Ian. And Tom.
Thank you very much. Great contributions, great research. After having written a few essays on today's themes for the JRF earlier in the year, I think what I can most usefully add, maybe all I can usefully add, is a bit of big picture context. I just want to underline quite how big the implications of some of this stuff are. There's a Stephen Fry novel where there's a crusty old history don who quips about things you can say about any time and any place and they'll always be true, such as an increasingly assertive middle class was on the rise. Any point of history you could say that and it works. And right through the 20th century, we thought that a rising tide of home ownership was one of those things as well. It seemed to be permanently true. And that conditioned the way that sociologists thought about class. It conditioned the way that economists thought about wealth and retirement, and the way that political scientists thought about voting. But throughout the 21st century, as we've been hearing, that tide that once seemed unstoppable has mostly gone into reverse. So when I had a look at the trends for JRF, there's always different ways of splicing and dicing the data. What I found is that since 2001, if we drop the pensioners, who've got a very different story, then what you see across the rest of the population is a 10 percentage point swing, if you like, from the home buyer category into the private rental category. It's like a really big shift. I mean, 10 percentage points in politics swing would be, the sort of record-breaking swing. So it's a really big deal. And again, if we put the special case of pensions to one side, that sort of rate of change is about the opposite rate of change. It's about the same scale that we used to see in the other direction in the 60s and the 70s and the 80s when home ownership was going up by 7 or 8 or 10 points a decade. Even on its own, this change from a society where ever fewer people have got a stake in bricks and mortar to a world where fewer have done. I mean, we'll see about whether the last couple of years have seen a second turning of the tide. But that would be a big deal, a very big deal, as I say, even on its own. But of course, it's not occurred in isolation. It's part and parcel of a wider rise of wealth, which we've been hearing about before the break this morning. Now, the point here is not higher inequality of wealth, inequality of wealth moves around in confusing ways, but simply the growth of private wealth relative to incomes, particularly in the long years of rock-bottom interest rates. Between the war and the 70s, private wealth was about 3 times the national income, and now it's more like 7 or something by the time we got to COVID. And if you just think about how wealth is always and everywhere much more unequal than income, around twice as unequal insofar as we can tell in the UK, I think, then, and also just think about how much of it's inherited, then I think you start to see the implications. A society that's much less ordered around what you can earn and much more around what you own. And Thomas Piketty's famous phrase here is patrimonial capitalism. And I think what today's research really brings out is what this looks like in relation to the most important class of assets, if you like, a patrimonial housing market. Now, the bank of mum and dad, whose scale you've elucidated so clearly, both reflects and also then reinforces this general rise of wealth. People in older cohorts who successfully rode the tide of home ownership when the going was good often have the wealth to help their kids get a house or get a bigger one or get it earlier, even though houses are very expensive nowadays. And younger adults who grew up in rentals only rarely enjoy the same support and hence find themselves locked out. And one of B's numbers, I think if I've got it right, is that the proportional drop, not the percentage point drop, the proportional drop in the ownership rate over the 2010s was fully 3 times faster among the children of renters, 45% down it came, compared to just 15% for the children of owners. So even without some disturbing new evidence on social mobility this morning, that kind of, dramatically faster fall amongst renters remaining as renters because of this falling home ownership sounds like a recipe for a sclerotic, almost a caste society, if you like, rather than the dynamic meritocracy that all the politicians have drone on about for a long time. And I think you can see lots of consequences, for example, in the deepening generational political divide. But this is an IFS seminar, so I do want to come back to the economy. Now, I spent much of this year holding the pen on the Resolution Foundation's bumper Ending Stagnation report, which you might have seen last week. And it warned that a sclerotic housing market could impede economic dynamism via the jobs market, via people not being able to go to the hubs of the future, if you like. A market economy relies on people being able to follow the money, but that won't work when housing costs gobble up too much of the gains. And that is indeed what we can see happening in productivity hotspots in Britain, where housing prices have been rising particularly fast. Resolution reported that the rate at which people have been moving home to take up a new job has indeed been falling. The share of young adults switching jobs and home at the same time, so people who it looks like they're moving in order to move jobs, that's down by 1/3 since 2000. And in parallel, we've had more people relocating to cheaper places, cheaper postcodes, which are probably also less productive postcodes. So the potential there on productivity and growth and that sort of thing is stark. But personally, I think it's also worth just pausing on the social fallout, and especially if we chuck in that bank of mum and dad effect. Because as well as translating into unequal home ownership rates, unequal family circumstances will then harden into unequal economic geography and unequal career chances. And so that's probably enough misery from me. So I'd like to just turn to what to do about it. Other that is than assuming that the ultra-easy money policies will, the ending of the ultra-easy money policies, the rising of interest rates, in other words, will put wealth and property back in their place. And they might help a bit, but Ian's done excellent work earlier, which has shown that they're unlikely to bring things back into the sort of kilter they were in the 60s or 70s. So what else is there? More houses are probably a good idea, and just as we've heard just now, low elasticity estimates suggest that this might well take reform, because within current rules, market signals aren't seemingly able to do the job. I also think we need more social housing that has to be concentrated near the productivity hotspots, because you don't want those hotspots to become the preserve of an elite. Beyond that, though, I think the message I took from your paper was just target any interventions there are with great care. You know, because you show, for example, that if we shrink the deposit requirement, that would benefit 30-somethings with better off parents and northerners, but it would do little for poorer southerners who are really hammered by housing costs at the moment, where the constraint isn't savings but prices or something else. And past schemes like Help to Buy, some people have said anyway, have enriched, helped some home owners whilst also, first-time buyers, while also enriching homeowners by putting up prices and then locking some other people out. So, there are always trade-offs, and all I could say is, as a government comes in, identify those who look most badly shortchanged in terms of opportunities by the current system, and target any support really carefully on them. Because as you've shown beyond doubt, the Bank of Mum and Dad provides splendid resources for some, but leaves many others out in the cold. If we factored in inheritance, which we haven't been talking about much, all these divisive effects of gifts would surely get bigger. And given that, and the challenge of finding any support for anything, given the terrible state of the public books, it's entirely appropriate that after we've chatted more about this, we're going to move on to the question of taxing bequests and transfers. Thanks.
Fantastic, thank you. Well, first of all, just thanks again for two really brilliant presentations on two fantastic pieces of work, which you should really all read. Your one isn't actually available yet, so you're going to have to wait. You're going to have to wait, but make a note to read it and read B's one immediately after you leave today. Thank you so much for those, and for all three of you for some really, really thought-provoking comments. I've made a lot of notes here, and it's hard to know where to start. Can I suggest that we start by, I'd like to get some thoughts or comments from people on the issue of how all of this relates to geography, and including kind of geographic mobility. This has been something that I was thinking about throughout the first session, and it started to surface in this one, which I'm glad it seems like about time we moved to this. So here's the way I would bring together some of what I've heard on this topic. From B's work, we can see very compellingly that there are groups who are helped a lot to find housing or better housing in areas with more job opportunities. Or in higher priced areas, which of course we know tend to be areas with better job opportunities. And we know that it's also graduate jobs that tend to be most geographically clustered. And we also know that it's graduates who tend to be the ones who move areas. But we also know that from other work that even among otherwise similar graduates, it's really those who originate from better off family backgrounds who are really the ones most likely to move to where these very high paying jobs are. Similar graduates who did similar things at university, who come from poorer backgrounds, do that a lot less. Right, and so the question arises, of course, as to how much housing costs have to do with that. High housing costs, combined with the kind of variability and the sort of help that different young graduates can get from parents, from the Bank of Mum and Dad when moving to a higher cost area. And of course, that relates to some of Peter's work, because if you have a very low responsiveness of supply to local conditions, then it means you're going to get more variation in local housing costs across different areas. It's going to track much more closely the variation in labour market opportunity, which is a point you made really nicely, and framed around kind of the risk, lack of risk sharing that means, which I thought was a really, really nice point. So, I guess I'm interested in what you think about how important is housing in explaining these very different patterns of spatial mobility that we see among people from different backgrounds and different situations, even for a given level of education. I think we don't really have super hard evidence on it, but it's an obvious question to raise, and I'm interested in what you think about it. And any implications of that for a government wanting to address social mobility, given this kind of link with geographic mobility and in turn probably housing. Does anyone have any thoughts on that sort of set of issues, how all this relates to geography, basically? Yeah, Anthony.
Yeah, sure. So, really good question. I don't think it's a coincidence that we have really bad housing crisis and really bad regional inequality. it's quite clear that the effect of housing costs, certainly on mobility between graduates and non-graduates, I'm not quite sure about that kind of, there must be this kind of dynastic link where it really matters, what kind of graduate you are for mobility. But the fact that housing is so unaffordable in London, Brighton, Oxford, Cambridge, etc., creates these very strong selection effects whereby only graduates can afford to move to these areas, and because the earnings premiums that graduates get relative to non-graduates are large enough for them to be able to access that labour market and the progression, pay benefits, eventually home ownership opportunities that brings. So there's kind of the national housing shortages, and there's kind of these national mismatches in supply and demand create both inequality across the country, but also inequality within cities, right? If you're a renter, and I'm a renter, my home-owning neighbours are, even if they're on exactly the same salary as me, are much wealthier because they have an asset. They've had some kind of forced saving effect in a very successful labour market, and thereby, over the long run, a very successful kind of housing market as well. So I think from that, what I would conclude is that building more housing, particularly in those parts of the southeast and other successful urban economies, isn't just going to help reduce national inequality across geography. It will also help reduce inequality within places as well. So there's not necessarily this tension between, do we help poor people in the south, or do we help kind of poorer parts of the country? But as well as this wider context of building more stuff is good for national productivity growth, with densification and more construction jobs, more tax revenue, etc.
Does anyone else want to come in?
Sure, I come in on that, Rob. I mean, I think the, I guess one thing that obviously B's analysis shows is that these advantages of wealth are very significant, and they're not going away anytime soon, I don't think. I mean, they're not even going away, even if you hit the government's kind of housing supply targets, they're still going to be with us. So that wealth challenge is going to be there. Unless and until, I think, the impact of interest rate rises starts to bring price to earnings ratios back to something closer to their long-term average. But as Tom said, it's not going to, that doesn't look like it's going to totally bring us back to sort of late 20th century kind of norm. So the wealth inequalities are going to persist, and that will drive geographic mobility. So I think where policy needs to focus is what can it do to help the people who don't have that opportunity, and that's where I think things like mortgage guarantees and long-term fixed-rate mortgages, which alleviate both the deposit requirement but also the affordability test, are important avenues to look at. And I think the game here is not about increasing the supply of credit into the housing market. It's about shifting the balance for who gets to borrow, because no one, at whatever the price to income multiple, nobody can afford to buy a house, or hardly anyone can afford to buy a house unless they're able to borrow. And so the question of who gets access to that borrowing is key. And what we learned after the financial crisis was that borrowing got shifted away from first-time buyers who were seen as too risky. It got given to people who already had wealth. That was, landlords, people with equity. They were less risky. They therefore got to borrow. They therefore benefited from the house price boom that happened subsequently. And unless you can address that, then that's a massive problem. The other thing that happened in the 2010s, of course, was not only did availability of credit to first-time buyers really deteriorate, but the interest rates they were paying were much, much higher than the interest rates for people who had large deposits, 25% or more. So what that meant was younger people, less wealthy people, first-time buyers, got stuffed in two ways. They couldn't buy, and when they could buy, they paid through the nose for the privilege compared to everybody else. And so I think we need to look at the redistributive role, not the aggregate role of more credit into the market, because I don't think you need to rebalance things away. And the government's done quite a lot on taxing, buy-to-let landlords and that kind of thing. And that's one half of the story. The other half of the story is, I think, enabling, taking the cycle out of lending to first-time buyers so they have a steady access to credit at a reasonable level, and that will help to give people a leg up who don't have wealth.
If I can just jump in on that, I think those are very good points. But I guess one thing about when we've looked just at a mortgage guarantee scheme, kind of bring it back to these geographical inequalities that Rob was pulling out, I guess there's one thing which is we do find that kind of more of those who live in the North and Midlands might be kind of directly helped by the kind of scheme that would just be changing the kind of proportion of the deposit that you might put down, just because more of these kind of renters in these groups are kind of closer to the frontier. So I think it might have important implications for, in general, thinking across first-time buyers, in particular those who can't access this help. But it might even kind of widen the kinds of inequalities that we see in kind of home ownership rates between kind of who can afford to buy in London and the southeast and who can afford to buy elsewhere.
B, can I just come back on that? Did you
Yeah.
look at all at because we found when we looked at this that
Yeah.
it wasn't a game changer to alleviate the deposit effects, which is, I think, what
Yeah,
you find too.
yeah.
But and nor was it a game changer to alleviate the affordability test. But
Yeah.
maybe if you do both, then you do perhaps have.
Oh, that's
did you look at
interesting.
that?
No,
at all?
we were just thinking really about changing the deposit limit. We didn't look at them kind of in conjunction, so that would be interesting to see.
Tom, did you?
Yeah, just briefly, I think one thing that drops out of that question and the discussion is the danger, if you like, of getting stuck in a bit of a sort of left behind trap. Because when you're thinking in terms of places, there's quite often a emphasis on like these forgotten towns, Redwall and all that, where people say we can't hang on to young people anymore. But actually, you look at some of these numbers and you think that the bigger danger is people being stuck in places where they can't carve out a future. And it's very hard by diktat to say we're going to create a kind of labour market pool in Bolsover or whatever, where people learn the skills that they'll need for tomorrow's economy. Having said that, just one thing that might make life a bit easier, given all the pressures on housing, are that if people need to train up, like by coming to London or Manchester or wherever it is in the first instance, then in principle, in a world of Zoom, which is still kind of quite new even to these 21st century trends we're talking about, they should be able to go to a wider range of places, go to places where there is a lot of housing. But then I'd add a caveat, having come down on a cancelled train from Yorkshire this morning, if you fix transport, like there is some substitution here. If we sort out transport, the housing thing isn't quite so acute.
Yeah, why not?
Complete the set.
Yes, no, exactly. So I just wanted to make the point, so it's in terms of when you're giving people, trying to get people to have access to these high productivity areas, and we're talking about getting access to capital, having these subsidies and guarantees and things, the point where the supply elasticity becomes really relevant is when you're thinking about who's going to benefit from these policies. Because if the supply elasticity is really low, then one of the key beneficiaries of any kind of demand side policy is going to be existing homeowners. So you might want to, you do need to think about kind of, yes, we can create greater access to capital for these people moving, but in conjunction with policies that would make it easier to build these kind of areas. And that's all I wanted to say.
I'm glad you made that point. Yeah, one of my concerns in the whole sort of levelling up area, and I must say this is not a concern that's been allayed when actually talking to people within government, if anything, kind of the opposite, is that it is seen purely as a geographic issue, which kind of maybe sounds a bit odd, but I mean, it's almost as though the model people are carrying around in their heads is there's one person in Birmingham, some sort of representative agent, and there's one person in London, another person in Hull, another person in rural Shropshire. And the goal of levelling up is to sort of lift up the representative agents in the less well-off areas to be more like the ones above. But of course, the problem with that is that there are lots of different sorts of people in any given area, and they're all linked very intimately via housing, because if you do something to make an area generically more attractive, you improve its labour market for some segment of the population, you're affecting everyone one way or another, because the price of land links them all together. And that's essentially what gentrification kind of comes down to, or a large part of it. And some of the people who could actually lose out could be some of the worst people in the whole country, the sort of poorer people in poorer areas who maybe don't benefit from the improving labour market, depending on what you've done there, but do pay a higher cost of housing. So, great point. I like that point. I think it's really, really, really important. I mean, maybe that links to another question I could raise for discussion then, which brings maybe us a bit closer to policy and kind of what's going on right now. Do people feel, when it comes to the levelling up agenda, that housing and the way that housing is featuring in that, to the extent that it is appropriate? Is this being paid close enough attention to, and how it links in with the whole levelling up agenda, to the extent we know what that is? And do we think that is sufficient? Anyone have any comments on that? Anthony first. Yeah.
So I think when you talk to people in Levelling Up department, which is also doing planning and housing as well, it seems to me that levelling up as an agenda and planning reform brackets kind of housing agenda, which planning reform is part of, are quite separate strands. And the people delivering them are kind of thinking about them conceptually quite differently. You don't see many of the devolution deals that are being agreed having much of a housing or planning focus, and a lot of the planning reform focus in recent years, kind of getting the levelling up bill, has been quite distinct to a lot of the the devolution changes that have happened within that bill. I think there's a couple of reasons for that. I think one is that it's quite difficult to see how you would do comprehensive planning reform across England without some kind of reforms of local government first. So, for instance, audience may or may not know, but local plans, which decide where houses go, are delivered by district councils, and local transport plans that decide where transport infrastructure goes for houses are done by county councils, which are above, right? And those two things are obviously meant to talk to each other over similar timelines, and be aligned, and obviously, they aren't, right? So there's an element in which the fragmentation of local government, both vertical and horizontal, makes it really quite challenging to deliver planning reform and housing in its current state. But I think if we get into a place where we have a more sensible structure of local government, I think clear overlap and opportunities for progress in this area, I think particularly in the big cities. I mean, our analysis, I think this is shared by certainly some of the officials in Whitehall and the government, is that levelling up isn't about kind of making every part of English economy the same, right? The economy is spiky. We see concentrations of activity and productivity in certain parts of the economy. But what really stands out about England in particular, and broadly Scotland as well, is that compared to other big developed economies, our big cities outside the capital, all of them underperform. So in most other parts of the world, the second, third, fourth, fifth biggest cities are more productive than the national average. In the UK, they're all below the national average. And what that means is that if we can get those big cities, which are all below their potential, performing at their potential, which includes changes to the built environment, as Ian was mentioning, it includes improvements to transport, it includes improvements to skills in these places, there's actually a clear win where we can reduce regional inequality because you put more people in reach of these really successful local labour markets, but also you're improving national economic growth as well because we're making the most of our assets and our big urban assets as well.
Yeah, Ian?
Just to echo that really, I mean, the Resolution Foundation's report last week drew on quite a lot of work that was jointly between the Centre for Cities and Resolution Foundation, which made this point that the UK productivity performance is going to be very hard to shift if you don't lead with your non-London cities, whose productivity performance is pretty bad. And so where housing comes into that is, I think we need to have very clearly in our sights that for my money, what matters less is how much you build, and so much as what really matters is where you build it. And if you don't densify your cities, or at least use transport infrastructure to make them more dense, even if they're spatially not so concentrated, then you're not going to achieve that. And I think we need to have a clear-sighted focus on that issue if we're going to sort of tackle the productivity challenges.
Can I pick up on, or I'll be back onto the housing supply, Peter? One question that strikes me from your work is, you don't seem to find any real change, certainly no improvement in the level of responsiveness of supply over time, comparing your two time periods. And I think you said that the share of available land has become a bigger kind of constraint, if anything, in the second period compared to the first. But my understanding, I'm not a housing policy expert, but I think quite a lot has been done over this broad period to try to stimulate supply. I think certainly if you counted the number of measures, you'd find a few. So do we conclude, has all of that failed, or am I misinterpreting, or am I overreaching in terms of interpreting what you found? How should we think
So a subtlety in interpreting everything we've done is we're comparing areas with each other. So within these two time periods, we get quite similar estimates across the two time periods. We're always comparing areas with each other. So if there's a big increase in housing supply, but it's uniform across areas, that won't register in our estimates as a difference between those two time periods. What we're saying is that in response to a local demand change, you don't see extra housing supply in those areas that had that higher price increase. So it's about the geography of the housing supply rather than the kind of aggregate amount of it. Yes.
Yeah, no,
yes.
that certainly clarifies. But you might hope that there would be policies which could change that too. For example, if you made, again, not being the housing policy expert in the room, but there would be changes you could presumably make to the planning regime which should make supply at a local level more responsive. Do you want to comment on that?
Yeah, sure. So I think when you look over the past decade or so, you have seen quite big planning reforms since 2011. The introduction of the NPPF, National Planning Policy Framework, took thousands of pages of planning guidance and boiled that down into just 50 pages. And that has made a big improvement to the functioning of the planning system, and house building has increased accordingly on greenfield sites to decade-long highs as a result. But the single most important thing, certainly at the local authority level, that determines whether housing is built or not, is whether a local authority, a district council, has a local plan in place or not. Because the way the planning system works is basically a local authority has the discretion to grant planning applications if the planning application is compliant with the local plan, and the local plan, because of the NPPF, makes site allocations. You get these big kind of housing urban extensions on the outskirts of urban areas. If a local plan is in place, it's relatively straightforward to get planning permission for large developments for the big house builders on the nature of those sites. But if you don't have a local plan in place, then there's not really any conditions by which you can subject the planning application towards, and therefore it's very difficult to get anything built within that local authority. And that's why, if you look at the the number of places that have local plans in place, you'll find a suspicious ring of places around London, in London's Greenbelt, that refuse to agree local plans, because they know that if they agree a local plan, then they'll be forced to build loads of houses, and it'll become much more difficult for them to block new housing. So I think that's kind of a marginal change within the system that we currently have, but to me, what that really indicates is we did move away from this case-by-case consideration where there's all of these presumptions where the local authority has the ability to deny planning permission, in favour of one that was more sensible, that still had rules, that still guided where development was and was not permitted, but was much more rules-based. I think we would see a big increase in house building, and if we integrated it with local transport plans, we could improve infrastructure provision as well.
Okay, so that's all been fantastic. Let's move to questions. We've got about 15 minutes or so left of the session, so let's take some questions. Do I have to choose the people who are... Let's go in the... I think you were very quick. Let's go to you first. And let's take three at a time, and we'll keep track.
Mohammed Amin, my question is for Peter Levell. And I was quite struck by your presentation, and in particular, how you mentioned that in certain areas, a lot of the supply is 1- and 2-bedroom flats rather than housing. And living in Manchester, I can attest to that, particularly in the centre of Manchester, we've seen enormous amounts of building of high-rise flats, densification, which I actually regard very positively. But my question is this. I'm aware that over a long time scale, there's been a gradual reduction in household size in the UK. Over the time periods that you've been looking at, has that change in household size come through in any way in what you're seeing in terms of demand, how you're factoring it into your calculations and research, etc.?
Okay, great, thank you. The gentleman down here, I think, was the second putting his hand up.
Hi, Michael Percy. I was interested about these issues about affordability, and I'm afraid that affordability, as soon as you make things more affordable, the house price rises to it. Having bought my first house in the early 70s, I've seen that so many times. And the idea of extending, as they are, mortgage terms for 30, 40, 50 years is merely going to say that the amount of the house price. But what I'm interested more in is, are we looking at an issue of volume of houses available being built, or are we looking at the accessibility of home ownership, which seems to be a social issue rather than a political issue? And I think probably that this idea that home ownership, which if we were in a Scandinavian country, we would be sitting here, why are we concerned about levels of home ownership in the way we are? Let's just have a house to live in. And I think we are perpetuating the issue that wealth is reflected in home ownership. The Bank of Mum and Dad, I think, is more the problem than the solution.
Okay, great. We definitely got the right people on the panel to address these questions. Question over here, please.
I was interested in your choice of time period, because where you started it in 1996 was, of course, immediately after a large fall in house prices in the first half of the 1990s. And we had seen a big rise in house prices during the 1980s as a result of right to buy and the housing flipping that was going on there. So what I'm looking at here is a rather striking chart, which shows, and it plays to this whole question of housing supply, because there seems to be a bit of a mantra, and actually none of the panel really fell into this, but I do hear this a lot saying, oh, all we need to do is build more houses, and then asking why it is that the private sector doesn't build more houses even when it's given huge incentives to do so. And I'm actually looking at a chart here dating back to 1949, which shows that the level of house building from the private sector has remained, with some fluctuations, broadly the same, since about 1960. What has fallen off a cliff in terms of providing supply is social housing. So should we be, as part of the increase in investment that both the National Institute and the Resolution Foundation have recommended from the public sector, be saying a fair chunk of that should go into social housing?
Okay, great. Actually, three quite related questions, actually. That all fits together very nicely. So we've got questions around, essentially, this question of whether it's really volumes that are the problem, or essentially issues around accessibility for certain groups, I suppose. Related to the question about the role of social housing specifically, as opposed to total numbers of houses being built, and also a question about how all this might be related to changes in household size. Can I start with Ian, because I know Ian's written about quite a lot of some of that. Do you want to kick us off?
Yeah, okay. Yeah, I'll tackle first this one about volume of housing or access to home ownership. I mean, I think it's good to call out that what's the kind of causal chain that we're positing here. And I think the general sort of thought is home ownership is low because prices are high because there isn't enough stock. And I think both chains in that need some sort of like watering down. Much greater volumes will only have a relatively weak impact on prices, and prices are only one factor, as I was describing, in determining home ownership. So when you put those two things together, it's not really a game changer for home ownership, I don't think. But you're right that they're separate goals. I mean, we might want to have more housing for, productivity reasons in the centre of cities. We might want to boost home ownership for other reasons. They're not necessarily linked, and I think we should probably be more explicit in separating out what our kind of like policy aims are in each of these areas, rather than sort of casually assuming they're all the same, all in pursuit of the same outcomes. I mean, I agree with Francis on the social housing point. I mean, just to reflect on the point I was making about supply elasticities, it's notable that private sector supply has remained pretty constant over decades and decades and decades, even though prices have gone up and up and up. What does that tell you about supply elasticity? I think it tells you it doesn't exist. But let me not labour that point. What I would say, though, is that it really underlines the point that I think is really key, that in housing we focus on, you can think about lots of policy issues in terms of the aggregates, how much of it is there, or you can think about it in terms of the distribution, who gets what in it. And I think we spend far too long in housing policy talking about how much of it is there, and not enough thinking about who gets what, especially when we've got things like local housing allowance being frozen, increased, but then frozen again, social housing being run down, and I would also put in that bucket credit being directed away from less wealthy people and towards more wealthy people. These are the distributional drivers of all of the housing issues we face, and we need to focus much more on them. There may be a role for aggregates as well, but I think it's very much secondary.
Peter, any of that you wanted to come in on?
Sure, yeah, so so the question on the sort of housing types. So we've drawn some quite boring looking charts of the change in the types of housing, the nature of the housing stock over time, and the bottom line, it doesn't change very much, and that's because it's quite slow to change a kind of stock. You have to build a lot of houses before the overall shape of the housing distribution changes. So what we're saying is kind of more that the marginal house that's built in these areas when prices go up, if it's a constrained area, will tend to be a smaller unit. Maybe that's what these policies are designed to do. Maybe the green belt is supposed to be, densifying our cities rather than leaving them to sprawl out. But it could have, interesting demographic consequences. Can you raise a family in a flat? Are people going to be raising families in city centres, or are they going to be moving out? What does that mean for the kind of, interaction between fertility and housing decisions? So those are sort of interesting questions, which we've only kind of scratched the surface of. The home ownership graph, how scary is it that home ownership has fallen, when other European countries it's different? I mean, I think a key thing is, yes, exactly. So it's one is the distributional question. So what does this tell us about inequality? And the other thing is that housing enjoys these kind of privileged returns. So it enjoys privileged tax treatment. It's been a really great investment for a number of years. So who has access to those privileged returns is the question. Well, yes. I mean, that would be the IFS solutions.
And they can be particularly just when you can make a transition from one state to another, right? You've got a high home ownership generation and then a lower home ownership generation below them. And then some of the intergenerational issues that we're talking about today become very pertinent for a period. Anthony, any conflict, any disagreement?
Yeah, sure. So I have two thoughts on this. One for the gentleman down here from Manchester. As part of our report, the one that came out just before COVID, called Sleepy Suburbs, we looked at Manchester as a case study, looking at kind of the spatial distribution of new housing within GM. And we found that city centre of Manchester saw a 25% increase in housing stock from 2011 to 2019. So a massive increase, way bigger than most other parts of England. But Greater Manchester as a whole actually built less than the average city in England. And the reason was because if you go out to the suburbs of Manchester, they were building nothing, right? You have this extensive green belt interweaving between the different urban areas that make up GM, but also the fact that Greater Manchester has struggled over the past decades to agree a joint local plan, right? And this comes back to these ideas discussing earlier about getting the local plan agreed in our system is sort of the on-off switch as to whether you get any house building in the local area. But I'd just like to come back to Francis's point there about kind of the history of house building, because we published a report earlier this year called The House Building Crisis. And Francis mentioned a chart there which goes back to 1949. And the planning system as we currently have it was created in 1947. And our analysis stretched back before that. Actually, we found data that went all the way back to the Crimean War on house building rates in England and Wales. And basically what we found was that the highest period of house building ever in England and Wales was the interwar period, and specifically the 1930s. And this is a big part of how 1920s in the UK were terrible. They were great in the US. In the US, in the 30s, it was the opposite. They were terrible in the US, and they were fantastic over here. But the late Nicholas Crafts did a great paper showing about 1/3 of our recovery during the Great Depression was built during that house building boom. But basically what happened was that immediately after the Second World War, and we introduced the planning system in 1947, house building rates immediately dropped by 1/3. So we had, although we were building quite a significant amount of social housing before then, we then had a big increase in social house building after that point, which is good. But then we had an absolute crushing of private house building after 1947, which more than outweighed the increase in social housing that was provided after the post-war period. Then, as the planning system tightened and became more restrictive, as we introduced green belts, as we introduced conservation areas, as we made the local planning system more restrictive, the house building rates for both private and social housing decrease from the mid-1960s through to the beginning of the Thatcher period and the 1990s. So I think, and this all plays part in the story. You can see this on the demand side as well, in that house prices outstrip wage growth from at least the 1960s. Onward across the UK. So I think this is a really long-term problem, right? And the evidence really does support the idea that the planning system as created in 1947 is really at the root of a lot of these issues. And if we removed it, we could build both more private housing and also more social housing, right? The planning system controls the supply of council houses and also housing association houses as well. So it's not planning reform or social housing, it's por qué no los dos? Like, why not both?
Great. Because we started just fractionally, I'd like to use those extra 3 minutes now to take another couple of questions. Only time for another couple, I think, because we've had so much great discussion. Who wants to ask? I can see two questions. So the gentleman down here, lady over there. Yeah, let's go. Thank you.
Yeah, it's just... Hello, does that work? Yeah.
Yeah.
Just come quickly back on this question of social housing, private housing. I don't think anybody doubts we've got a dysfunctional planning system. So you're already starting, one step back. I'm struggling with the idea that actually aggregate amount of housing is not that important. Kate Barker, in her report in 2004, quite clearly said that we didn't have enough housing then, about 100,000 units per year. And that's 20 years ago, and we haven't caught up by any stretch of the imagination, so the catch-up has got even worse. We've got an increasing population, if anything, about the Conservative government's concern about immigration, whether it be boats or legitimate immigration. So, frankly, we've got an increasing population and no adequate housing policy. And I was very interested by Anthony's point. The reality is it's the public and private sector together, and the Town and Country Planning Act 1947 clearly didn't do any favours to the private sector, but the fact is the public sector carried along. Now, if you have housing on the one hand, and you have the fact that the reason why you've got so many problems in London is that Norman Tebbit said, get on your bike to everybody in the rest of the country to come down here to search for jobs in houses they couldn't afford. But the job opportunities aren't available in the north, which is why the prices haven't gone up. So they're two different problems of the same coin, which is there is no industrial or housing strategy in the UK. You compare it with Germany, etc. So I would like to ask the panel, don't you really think that, okay, you've got to build different houses in different places, but ultimately we really just do need a lot more social housing, which provide its supply and demand. We haven't got the supply, and any fiddling around with help to buy or whatever is more likely to increase the cost because there's more availability of credit than it is to do with
Great.
anything else.
Good question. Thank you. Thank you very much. I have to just keep things reasonably brief. And one more question over here that I wanted. Yeah, thank you.
Yes, my question is, to what extent does the underuse of housing fit into all your various discussions? Because 70% or thereabouts of housing is under-occupied, and more than half of all owner-occupied housing has 2 or more spare bedrooms. And this has been a massive transformation in the last 30, 40 years. And the second comment is that as the Chair of Planning and Highways in the town where I live, one of the biggest problems we face is that there are loads and loads of developers who are getting permission to develop places that nobody local needs to live in. Their aim is to make loads and loads of money. Why not? But the houses they're producing are not the sorts of houses that local people actually need.
All right, great. So is it really right that we don't have enough houses? Again, what about social housing? What about the underuse of housing? We could have a whole other discussion about how some of the tax system might relate to that, which I guess we have to refrain from doing. And developers are basically doing the wrong kind of housing in the wrong places. I mean, Ian, I'm tempted to start with you again on the Kate Barker. Was Kate Barker wrong all those years ago? Or,
Well, I think that you can read chapter and verse on my blog about this. She was operating using the official projections of household formation, which, when the census came out, turned out to be completely wrong. And in subsequent censuses have continued to turn out to be wrong. So Kate wasn't wrong, given what we knew at the time. But what we know subsequently, it turned out to be wrong. We've consistent, I think just awareness of the basic stats is really lacking in the debate generally. I mean, we had 700,000 more houses than households in 1996. We've now got 1.6 million more houses than households. We have built faster than population growth for the last 25 years at least. You know, these are the basic facts of the situation. Now, that doesn't mean we've got enough. I'm not saying that. But what it does mean is we have to be a bit cautious about just saying we obviously haven't built enough and we've never caught up. The past 25 years just refute that, I think.
yeah, Tom.
I appreciate that, Ian, and also the balance of the last few questions for saying the easy thing here, and the thing that we're talking about a lot because it's the thing that the Labour Party would rather talk about at the moment, is let's just build more houses. but actually underneath the surface of this, there's a whole load of distributional questions. First of all, social housing. Yes, we'd like, it'd be good to have more. The truth is it collapsed in 1975, 1976, I think, on the chart, if you look right back, which is, that's when I was born. It's a long time ago, and I'm not optimistic of turning it around quickly, but that absolutely should be an ambition. Secondly, underused properties. I saw a stat recently, I didn't look into it, but it sounded plausible, that there's actually been an increase, and this would make sense of your figures there, an increase in the number of spare bedrooms in the country at the same time as we talk about a housing crisis, which then takes you to that question of what houses are we building and for whom. But where I think it does link the distributional question and the volume of housing question in a way that both parties are now getting interested in, which is great, is who's going to get the gain when we do build. For too long we've said whatever farming family happens to sit on this field that we're now is going to suddenly see a tenfold increase in the value of that field by the stroke of a bureaucrat's pen. I mean, this is the kind of thing that a kind of Adam Smith or a Ricardo would have been horrified by. And what we need to do is find a way of saying, well, look, there are, even if you get the governance right, there's going to be hell on earth when you try and build in semi-rural seats. And we need to make sure that the gain of that is somehow shared with the community by ensuring that the uplift in value takes place after we've taken the field off the farmer. And it could go in cheaper council tax or whatever, but that might start to change decisions.
Fantastic. So I think we'll have to wrap it up there. There's just been so much great discussion. We didn't really touch on the development point, but I suppose one thing quickly to say is that Peter's results would certainly be consistent with this. If there are houses being built, they're certainly not responding to changes in needs. Sorry, we didn't get to cover that one of your points more thoroughly. And some of the issues around underuse might come up again in the next session, because certainly our tax system encourages people to hold on to rooms they don't need anymore in a number of ways, including through inheritance tax. So that might come up again. Thank you very much for a great discussion, and again to all of the speakers for their fantastic contributions. It's been really, really interesting, and enjoy your coffee.